In fact, markets have not really moved the way we actually thought. But also remember, we've had a good Friday, a decent Tuesday. So a lot of good things which have happened in the world also somewhere some would argue is getting discounted. So Seshadri Sen, head of research with Alchemy Capital, joins us. Good morning. Good to have you back. How are things?
Good morning. Yes, all good. All good. Thank you. Thanks for calling for inviting me to your show.
So I'm glad that we are getting a chance to meet outside the studio and outside work also.
Absolutely, absolutely. It's great to be out and meeting people in person.
What do you make of the credit growth which has just come out? Whether it is AU or whether it is HDFC Bank, even a franchise like Bajaj Finance on a large base is now talking about a 5 to 6% sequential growth. Why is this growth coming? From where is this growth coming? And what does that mean?
I think this growth is coming from two sectors. The overall take on the credit growth is that the economy is bouncing back after 2 or 3 very difficult years, where some part of the year was affected by closures and lockdowns. This is the first year in three that we are seeing, a full operating 365 days a year, and that is reflecting in credit growth, in increased economic activity. On top of that, we've seen consumer demand remain quite resilient. There were fears that, on the top of COVID bounce, that there would be some moderation. That is clearly not happening, and you're seeing a lot, significant consumer demand coming through. And it's not just retail lending which is driving this. You are seeing SME demand coming back fairly strongly. That is just from the data and from the commentary that most managements are putting out. If you scan through them, they're all seeing a lot of traction in SME demand and corporate as well, partly because inflation does affect drive up working capital demand. Some of that is coming through. I'm not sure the capex increased capex is yet flowed through to credit demand, but I think over the next year or so that will also kick in as far as corporate demand. So it's good, healthy growth coming from all the segments in the economy.
Is this going to sustain? How much of the credit growth do you think is also a function of the fact that there is festival season around the corner and that has added to a huge retail bump up?
Uh, well, third quarter will be even stronger if it's festival demand driving it. If you look at a 2 to 3 year basis, I think we are, given where the economy is going, I think credit growth will sustain in the teens for at least 2 to 3 years. We've seen a long winter for credit growth. Some of that is because banks were in significant risk-off mode after the asset quality crisis of the late noughties. That is starting to reverse. And if you take the big picture, I think we are in for a 2 3 year at least multi-year economic growth, and the underlying credit demand will support that somewhere in the teens. The drivers will keep changing. Today is festival demand. Tomorrow it will be capex. The third day it will be housing demand. So there will be various factors which will drive that at very different points in time. But the big picture is that we are set for a 2 3 year sustained credit growth as far as the sector is concerned.
Um, at what point in time, Sheshadri, you would say that affordability comes into play? Because if home loan rates, which were at let's say 6.5%, have now gone to 8.5%, car loans which were at 6, I mean 7, must have gone to 10. So while we may feel happy about the current credit growth, at some point in time it will start affecting affordability. Forget NPAs. NPAs I'm not even getting there, but basic affordability will start getting affected.
That's a fair point, but let me break that down. It's only home loans which actually get impacted by this, and because the rest of it, as a percentage of borrowers' incomes, is not that great. Car loan going from 7 to 9%, the increase in EMI as a percentage of the borrower's income is not that high to impact affordability and demand. Uh, we also have to remember that organized sector wage inflation is phenomenal, right? Meaning you're looking at last year, you look at all the listed companies, their disclosures, the commentaries around that. you've seen organized sector wage inflation at very, very strong over the last 2, 3 years. So that will help cover some of these increased interest costs. As far as home loans are concerned, the demand for housing, interest rates is a factor, but there are other factors as well. The second is, of course, income, which I just alluded to. The third factor is the expectations of house pricing. And as long as those are all positive, just higher interest rates usually does not slow down demand. There may be some down trading because yes, affordability. If you could afford a price of a house of X, you will down trade to a smaller house. But the demand continues. It is only when housing loans go close, housing loan rates approach the double digit mark, that really demand starts getting affected. That's the sort of history I've seen over the last 20, 30 years that I've been tracking this sector. So I don't think there's any cause for alarm yet as far as housing loan demand is concerned. There may be some down trading where people are buying smaller houses or buying a house that's further out in the suburbs, etc. But I don't think demand will get affected immediately.
Want to understand that with the kind of growth that we're seeing as well, there does come risk. So, do you believe that now we're seeing banks taking larger risk in order to accommodate growth at the moment? And if so, which sectors do you believe these risks are really emanating from?
By and large, banks are in risk off mode. They are, risk of aversion among banks is probably at the highest I've seen in many, many years. If you're a corporate with a slightly dodgy credit rating, it's almost impossible to get funding. If you're a borrower with a low credit score, it's difficult to get funding from the banks at least. Therefore, some of the peripheral players come into play as far as those markets are concerned. So at the moment, I'm not really worried that we are building up into an asset quality bubble. I think we are going to see, very strong asset quality trends for at least another 4 to 6 quarters, after which seasoning will catch up because we are seeing growth after a longish gap. So seasoning will catch up. But as far as asset quality bubbles, I'm not really worried. One sector I will keep an eye out because that's where there's been a lot of aggression across, from banks, NBFCs, and fintechs is SME. But there again, I think SME balance sheets post-COVID have improved significantly. We are seeing, as long as the broader macro growth, broader economic growth remains at 7% plus for a 2-3 year period, which we think it will, then I think SMEs should also be fine. But if there's one area that I would keep an eye out on, it would be that.
So is this one of those phases where the winner takes it all, or it's a rising tide phenomenon, everybody will make money?
The latter. I think across the space you will see all the entire sector starting to benefit over the next 2 to 3 years. Yes, I've said it before. Last time I was on your show, I said yes, the structure of the industry is such that the bigger players benefit more. But for the smaller players, we are seeing some breakout trends which we are monitoring closely. Two among those are the fact that post the bank crisis of 2019 and 20, there seemed to be a risk aversion among depositors, and depositors were flocking to either the state-owned banks or the top 3 private sector banks. The data that we are seeing for the smaller private banks, that trend seems to be slowly turning. It's not a huge flow yet, but it's slowly turning, and the retail deposit ratios for all the smaller banks are steadily improving every quarter. The second is what I just alluded to. The credit quality scenario is so benign that the lendable universe is expanding all the time. Also, access to borrowers with fintech, with public data availability is starting to improve. So it's less difficult, I would say, for a smaller bank to reach a high quality customer than it was, say, 5-6 years ago. So all that I think will lead to, say, a democratization of the space where everybody will grow. The larger players will probably continue to consolidate the position, but given that the industry is in a 2-3 year high growth phase, I think well-managed smaller banks could also benefit from this trend.
Thank you for taking time out and joining in, sharing with us your outlook on the bank credit growth, the overall credit uptake, as well as the markets. I just want to